So let's talk top down, Tim. I think that's how you and I both look at the market. Some people are bottoms up fundamentalists, which is fine. I look at that too. But I always kind of like to know what's going on big picture. Of course, headline wise, the House just passed the debt ceiling bill. It goes to the Senate. We've got mixed views in terms of what the Fed does or doesn't do in the June meeting. Also, and I want to really get your take on this today. The GDP in Canada came in stronger than expected. So, what does that mean for the Bank of Canada next week? And then all the trickle down effects that we need to be thinking about on the back of all of that. So, what's your current view, top down?
Well, that's a mouthful. I think I think it's interesting. You know, obviously, the fear that most of these central banks had in terms of structural inflation is kind of is there, right? It's embedded. You and I look up here, we see these union contracts, whether it was the government workers, you saw the WestJet pilots recently, et cetera. So, this is now filtering through, right? But let's break it out for all of our our audience and our investors. Everything at some point comes down to supply and demand, right? I mean, and you and I are absolutely, from a macro perspective, if you get that wrong, you're shuffling deck chairs on the Titanic, right? So you're looking at it going, what are we seeing here? And I think from a rates perspective, Catherine, I mean, it's anybody's guess as far as what the U.S., the Fed's going to do in June. They're talking out both sides of their mouth. The numbers, I will tell you that, over the last couple of quarters, I've looked diligently at about 80, 85 companies in about 33 industries. And what it's saying to me is that things are kind of okay, right? I mean, they're kind of plodding along. I'd say 90% of the earnings that I've seen in various industries are, kind of dull, right? I mean, they're sort of hanging in there. They're neither growth nor again, nor declining. And you have about 5% that are, especially in the goods economy, that are getting pounded, and then 5% that are, kind of doing well. So this is kind of the backdrop, right? So there's a lot of histrionics, in the market. It's like, oh my God, stocks are ridiculously expensive. And then on the other hand, you've got this whole AI nonsense that's kicking in, and it's all going to be another productivity enhancer. Earnings are going to be soaring. So it is probably, for you and I, in terms of our careers, I'd say it's probably the most, contradictory, confusing market. And I'd say that rates are going higher. I think 3 month LIBOR is 5.5% right now. And I understand LIBOR is going away here soon, right? Allegedly, 3 month LIBOR is stop being quoted in the next month or so. But I use it. It's SOFR now, but it's obviously the
Hmm.
same type of a number. I guess the question that you and I think all investors are wrestling with right now is how is it that we've raised rates 530 basis points in the short end and nothing's completely broken? We had some bank crisis, but I mean, honestly, when you look through from a banking perspective, that's just mismanagement, right? I mean, you can't match up interest rate and duration risk. That's your entire flipping
Hmm.
job, right? I mean,
Right.
that's just pilot error. So, I remain kind of dumbfounded in some areas where the system is levered, right? We've created about $60 trillion of additional debt since COVID, and somehow this is all just going to work. So, I don't know. I mean, you'd be calling for risk premiums to increase. You would think that valuations would come in and come down based on all this stuff. But markets don't care what you and I are thinking right now, right? In that regard, and they're kind of hanging tight. So I would say that for the first time in, I don't know, couple of decades, fixed income offers an awful lot from the standpoint of a risk-adjusted return. And will we see the inevitable shift, from dollars? Because this was the argument, right? Is to say you're going to see a shift out of equities, you're going to see a shift, into fixed income, particularly as the demographic ages. But honestly, Catherine, we're not really seeing that, right? I mean, the pitch from the community is that this is going to be a better hedge over here from an inflation perspective. We're not falling off of a cliff. Things are okay. So it's pretty complicated. It's pretty confusing right now. But I think we're still going another 50 basis points, and we'll see, right? Because I mean, structurally, inflation it's not moving.
Right. And that was your point as it relates to the unions. We are going to see higher for longer wages. It's a structural issue, which is exactly what the Fed and probably the Bank of Canada did not want. We're going to take a
Right.
quick break. We'll be right back.